Imagine saying no to thousands of pounds now, only to get richer later. Sounds crazy, right? But that's exactly what thousands of smart pensioners across the UK are doing, boosting their retirement income by a whopping £667 every single year for the rest of their lives. I'm talking about a little-known DWP pension hack that could add thousands to your retirement fund, or cost you dearly if you make one simple mistake. The government isn't exactly advertising this option, but today I'm pulling back the curtain on state pension deferral and revealing who should jump on this opportunity, and who should run far, far away. Before I reveal the strategy that could change your retirement forever, smash that subscribe button and hit the notification bell so you never miss out on these hidden money secrets. And drop a comment right now telling me your biggest retirement worry. I read every single comment and might address yours in our next video. Let me introduce you to Margaret. She's 66, just reached state pension age, and was about to claim her well-deserved state pension. But then her neighbor mentioned something interesting: pension deferral. Margaret had never heard of it, and honestly, most people haven't. But this decision could mean thousands of extra pounds in her pocket over her retirement years. So what exactly is pension deferral? Simply put, it's telling the Department for Work and Pensions, no thanks. I don't want my pension money just yet. I know what you're thinking. Why on earth would anyone turn down money they're entitled to? Well, that's where it gets interesting. For every year you defer taking your state pension, the government will increase your future payments by nearly 8%, which works out to about £667 extra every single year for the rest of your life. Think of it like this. You're loaning the government money now, and they're paying you a pretty impressive interest rate on that loan. But here's where most financial advisors get it wrong. They don't tell you about the crucial break-even point. According to investment firm Charles Stanley, you'd need to live at least 20 years after taking your deferred pension just to break even on what you gave up in that first year. That means if you defer at 66, you need to live until you're at least 86 just to come out ahead. Let me ask you something personal. Think about your parents and grandparents for a moment. How long did they live? Do you have longevity in your family? Because this decision is essentially a bet on your own lifespan. Let's look at two different people making this decision. First, there's John. He's 66, smokes regularly, has had 2 heart attacks, and his parents both passed away in their early 70s. For John, deferring his pension makes absolutely no financial sense because he's unlikely to reach that crucial break-even point. Then there's Diana. She's also 66, exercises daily, has excellent health markers, and comes from a family where her parents and grandparents all lived well into their 90s. For Diana, deferring could be an excellent financial strategy because she's likely to live well beyond that 20-year break-even threshold. But wait, there's something absolutely critical that most financial experts won't tell you about. If you or your partner receives pension credit or income support, stop right there. Deferring your pension could actually reduce your overall benefits and leave you worse off. I've seen this mistake cost vulnerable pensioners thousands, and it breaks my heart every time. Let me tell you about Harold, who deferred his pension while on pension credit. He thought he was being clever, but ended up losing nearly £3,000 in benefits before a welfare rights advisor caught the error. Don't be like Harold. Now, let's dive deeper into the numbers, and I promise to make this simple. According to Money Saving Expert, that's Martin Lewis's trusted financial advice site, if you defer for 1 year, you're giving up approximately £11,978 in pension payments. In return, you'll get an extra £694 every year for the rest of your life. So here's a question for you. If you put £11,978 in a savings account today, what interest rate would you need to generate £694 a year? The answer is about 8%. That's significantly higher than most savings accounts are offering right now. But remember, this only works if you live long enough to collect those higher payments for at least 20 years. Here's another way to think about it. Would you rather have extra money now when you're younger, more active, and potentially able to enjoy it more? Or would you prefer a higher guaranteed income in your later years when health costs might be higher? I spoke with Eric from Manchester, who deferred his pension for 3 years because he was still working part-time as a consultant. It was the best financial decision I ever made. He told me, I didn't need the money then, but now that I'm 82, that extra £2,000 a year makes all the difference to my quality of life. On the flip side, Patricia from Cornwall regrets her decision to defer. I deferred for 2 years, but then had a stroke at 73. I'll never reach that break-even point now. And I wish I'd taken the money when I could have used it for some nice holidays while I was still able-bodied. I asked pension specialist David Thompson about who should consider deferring. Here's what he said. Deferral makes the most sense for three types of people: those still working past state pension age who might face a high tax bill if they take their pension, those who have reason to believe they'll live well beyond the average life expectancy, and those who have other income sources now but want to maximize their guaranteed income in later life. Now, here's something that might surprise you. Tax considerations can sometimes make deferral more attractive than the raw numbers suggest. If you're still working and taking your state pension would push you into a higher tax bracket, deferring until you stop working could save you a significant amount in income tax. Let's say you're earning £45,000 from your job. Adding a state pension of nearly £12,000 would push some of your income into the higher rate tax band. In this scenario, deferring until you stop working could be a very tax-efficient strategy. But wait, there's another twist in this story. The rules for deferring are different depending on when you reached state pension age. If you reached state pension age before April 6, 2016, you have a choice. You can take your deferred pension as a lump sum or as increased weekly payments. However, if you reached state pension age after that date, you can only take the increased weekly payments option. Did you know that the longest anyone has ever deferred their state pension in the UK was 45 years? One woman didn't claim her pension until she was 105 years old. Now that's extreme pension planning. Of course, I'm not suggesting you wait quite that long, but it does raise an interesting question. How long would you be comfortable deferring your pension? Here's another critical consideration: inflation. The state pension is currently protected by what's known as the triple lock, meaning it increases each year by the highest of inflation, average wage growth, or 5%. Your deferred amount benefits from these increases too, potentially making the deal even sweeter over time. Now, I know what some of you are thinking, but what about investing that money instead? It's a fair question. If you took your pension and invested it in the stock market, could you beat that 5-8% guaranteed increase from deferring? Possibly. The long-term average return from the stock market is around 7 to 8%. But remember, that comes with risk. The 5-8% increase from deferral is guaranteed for life. No market crashes, no investment fees, no sleepless nights worrying about your portfolio. For many risk-averse pensioners, that certainty is worth its weight in gold. I know dealing with the DWP can sometimes feel like wrestling an octopus while filling out tax forms, but the process for deferring your pension is surprisingly straightforward. You don't even need to tell them you're deferring. If you do nothing when you reach state pension age, your pension is automatically deferred. When you're ready to claim it, you simply contact the pension service. But be careful, if you want to defer after you've already started receiving your pension, you must tell the pension service, and different rules apply. Deferring your state pension isn't for everyone. It's a deeply personal decision that depends on your health, financial situation, and even your family history. But for the right person, it could mean thousands of extra pounds over your retirement years, money that could fund those luxury cruises, help out the grandkids, or simply provide greater peace of mind. Remember Margaret from the beginning of our story? She decided to defer her pension for 3 years while she continued her part-time job at the library. When she finally retired completely at 69, her state pension was nearly £2,000 higher per year than it would have been, money that's now funding her passion for travel and gardening. But Margaret's neighbour, with his health conditions and dependence on pension credit, made the wise choice to take his pension immediately. One choice, two very different correct answers. That's the thing about personal finance, it's personal. What works for one person might be disastrous for another. The key is having all the information to make the best decision for your unique situation. If you've found this deep dive into pension deferral eye-opening, hit that like button to help more people discover this information. The algorithm loves engagement, and your thumbs up helps fellow pensioners find crucial financial advice. Have you deferred your pension or are you considering it? Share your story in the comments. Your experience could help someone else make this important decision. And if you want more videos breaking down complex pension rules into straightforward advice you can actually use, subscribe to our channel and hit that notification bell. We release new videos every Wednesday tackling the retirement questions you're too afraid to ask. Remember, retirement planning isn't about following what everyone else is doing. It's about making informed choices that work for your unique situation. So take this information, consider it carefully, and make the decision that's right for you.